Good afternoon and welcome to this NGPF webinar, What's Trending in Personal Finance. My name is Tim Ranzetta. I'm the founder of NextGen Personal Finance and happy to be with you here today. This topic today really came out of ongoing conversations we have with teachers who lament the fact that this is an industry that is fast changing. The personal finance landscape is very different than it was 10 or even 5 years ago. And they have trouble, given their current curriculums, of being able to teach these new concepts. So that's really the purpose of the call today, is really to provide you both with trend information, but also ideas and techniques you can use in the classroom. So I wanted to kick off first with just a quick polling question. So momentarily you will be receiving a polling question. If you could respond to that, and then we will go ahead and share results. So I'll give you a minute to respond. The question is, how satisfied are you with how well your current curriculum integrates current events? So what is your ability today and to really provide students with up-to-date information on new developments, new products in the personal finance space? All right, looks like I'm preaching to the choir here, and that this is precisely what I expected and why you're on the call today, and that 71% of you are unsatisfied with how you're able to integrate current events. So my hope is that you will walk away from this webinar and have information that you'll be able to readily implement in the classroom. So a couple of housekeeping items before I kick off. I'm going to try and keep this to a 1-hour presentation. We will be emailing handouts out tomorrow, so you'll have those available to you with the links to the specific activities that I discussed during this webinar. There's a question button on the right-hand side, which you can click at any point. I'm going to hold Q&A until the end. And then finally, if you enjoy this webinar, there'll be an archived version available on our website, so please tell your colleagues about it also. So again, my goal today, I had to make a decision coming into this webinar in terms of whether I wanted to go deep on a few issues or go more broadly on many issues. And I know that personal finance educators are really a diverse bunch when it comes to what information they teach and what information they're looking for. So I made the choice to really go broad in terms of the topics I'm going to cover in terms of new developments in personal finance. And then the second, I think, more important part is providing you with teaching techniques that you can incorporate to teach students about these trends. And I think this is an incredibly important set of skills that if we can let the students drive their learning, which we're going to talk about a lot today, it's so critical because this is an industry that changes so frequently. And if we can only provide students with, research skills, decision-making skills, and ability to compare alternatives, how to find reputable sources of information. All of those things are so critical and will outlive any concepts that we teach them or any vocabulary terms because things are changing so dramatically. So why are they changing so dramatically? I think it's almost a dizzying pace when you think about the new products, the new apps, all the new things happening in the financial technology space. And I think this graph, more than any, really shows you why. This basically looks at the amount of financing activity. So how much are investors pouring into startups in what is called the fintech space or financial technology? So from about $1 billion in 2008 to over $12 billion in 2014. And I think more impressive is just the growth between 2013 and 14 alone, where you're pretty much tripling in size. And so this is money going into companies, some of which you may be familiar with. So on the investing side, companies such as Wealthfront or Betterment on payments, Square or Venmo, on peer-to-peer lending, companies like Lending Club or Prosper, free credit scores from a company called Credit Karma, and then a real popular crowdfunding site, Kickstarter. So these are all examples. And why is this happening today? Why such a jump? I would attribute it really to the rise of the smartphone and the fact that the belief that the incumbents being the large banks and other financial institutions, are really threatened as consumers, particularly young consumers, are very comfortable doing business on their smartphone, whether it's transactions, banking transactions, or investing in stocks. They're very comfortable that way. And so basically these new companies are trying to get in between or develop new sectors, new segments, away from the incumbents and being able to satisfy customer needs. And so that's really, I think, the major factors driving this. So the first topic we're going to cover is really more of a behavioral shift than it is a trend, and that is, how are young people managing their bank accounts? And so what this slide shows is millennials will do almost anything to avoid visiting a bank branch. So only 12% indicated that that was their preferred method for meeting their banking needs. And so they're much more comfortable using bank apps, which was the number one choice, or bank websites, which was close behind. They also love to text. And so they love the thought of receiving text notifications from their banks also. And so what's interesting here is the large percentage that say they want to be notified anytime a transaction occurs, a deposit or a balance notification. And yet there's a gap between what they want and what they're actually getting. And it's unclear to me whether this is just a behavioral issue, where this is theoretically what they want and they're not following through and implementing on their bank app, for example. They're not setting up these text notifications, or whether it's a question of their banks not offering those services. My sense is it's more of a behavioral issue, because I think it's almost become a cost of doing business in terms of banks allowing their customers to set up alerts. And so this is incredibly important to understand, I think, when we're teaching young people, because, for example, we know that overdraft fees are a huge business, $30 billion plus for the major financial institutions. And yet there is technology now available where consumers, when their balances hit a certain level, they can alert themselves and hopefully preempt any overdraft that might occur in their account. So this is an example where technology can be a positive force in helping reduce overdraft fees. So then the question becomes, given those trends, how can we, in effect, give students practice with online accounts? And so we got a question from a teacher one afternoon who asked us, she traditionally had taught, as many of us do, students how to balance a checkbook, but realized with many students that wasn't something they were interested in, or was outside their realm of experience. They really weren't interested, and they wanted to know how could they manage their online bank account. So we spent a little bit of time, and we actually found a English company, an English website called Money Matters to Me, and they had an online simulator. And so I won't, given the time constraints here, I won't take you to the website other than to let you know we created a project or an activity around this, where we gave students a series of activities to go through in understanding online banking. So in this case, we have them conduct some transactions, and we make it clear to them that when they enter these transactions, the money is immediately being pulled from their online checking account. And we also set it up so that with the bills that we have displayed here, they actually overdraft their account, and then they've got to come up with steps they can take to fix their situation. So just getting them comfortable. If anybody else has any other sites that they can point to, but I thought this was, we've gotten great feedback from teachers that this really gives students hands-on experience in working with an online bank account, because that's the reality in which they play today. Another activity we have set up here is analyzing how we interact with banks. So this is a research report from the Federal Reserve. I think it's a one-page report and just gives information about the various payment methods and how people are interacting with banks today. And the third is something we call a question of the day, and this actually appears on our blog. I manage our blog. I think we have over 600 entries today. And what I'm looking for in the blog is really taking a current event. It's really the subject of this webinar, which is how do you take a current event and create it into a mini activity or mini lesson in the classroom. And so in this case, even though we know students or young people hate going to a bank branch, they typically will go there to set up their account for the first time. And one of the key planks within the NGPF curriculum is the belief that students need to understand incentives. And so in this case, we talk about a common, what we found to be quite common within bank branches, the fact that representatives would receive an extra commission if they could convince new account holders to sign up for overdraft protection. So this just gives them, we know they're going to step into a branch probably at some point to set up an account, and arms them with the knowledge that there may be incentives on the other side of the table that they should be aware of before they say yes to a service like that. So the next topic I wanted to talk about was payment methods. And we see this generation being quite different from earlier generations in terms of what their preferred payment method is. And so what this chart shows is roughly 20% of young people between the ages of 18 and 24 use a credit card as their preferred method, and the other 80% are using cash-like instruments like a debit card or actual cash, or new technology, new payment technologies like Google Wallet or Apple Pay on their smartphones, or peer-to-peer payment systems like Venmo, PayPal, or Square Cash. When I look at this, I bet if we looked 10 years ago, it would have looked quite a bit different. I think probably two things have happened since. One was the Great Recession occurred, and I think young people saw problems that occurred perhaps in their family or in their neighborhoods with people who took on too much debt, and so they're more debt averse, with the exception obviously of student debt, which we see continuing to increase, but kind of non-student debt loans, I believe, are probably this generation this generation coming of age is a little more averse to debt. The second factor is really the fact that the Card Act, which came into place in 2009, I believe, which makes it much more difficult for somebody under the age of 21 to get a credit card unless they can convince a parent to co-sign for them, or they can show they have an independent source of income to be able to pay off the bill. And so these are the dominant payment methods that we're seeing among young people. So then how do we take that information on that trend and make students more sophisticated about these online tools and apps? And so we've created a project here which we call Online Tools and Apps. And again, there's a link to all of this in the handouts that we'll be sending out to you. And the crux of this project is to have students go and analyze popular personal finance websites and mobile apps. And so here we give them 4 as kind of practice. Let them go out and each of these websites, figure out what the purpose of these websites are, what some of the benefits might be of using it, and then asking the personal question, is this something that they think they would be interested in? Why or why not? And then part 2 is asking them to either pick one of those 4 digital resources or one of the companies listed below and do a more in-depth analysis. And so we provide a list of questions. Those in bold are mandatory. And once they've completed that, then there's an opportunity for them to use their creativity and really choose one of these 5 projects. Perhaps they, work at the company and they were tasked with creating a 60-second TV commercial. What would they develop? Maybe it's creating an informational pamphlet. Anyway, these projects are really a way to extend their learning but it's something they're excited about, because we all know how, when you look at any young person's smartphone, how many apps they have on it, and we're really just trying to teach them to be more critical and more thoughtful about what apps, particularly around the personal finance, they might be interested in. So this template that we're providing to you really would be useful, not only, for, in this case, we're looking at kind of the broad measure of what we call personal finance apps, but you'll see something very similar for what we do with budget apps, and can be applicable to new products. There's a lot of new products, and I think a valuable way to teach students is to have them be product reviewers and go out, and if it's an app, maybe it's download it, use it for a period of time, and then write a review on it. But this can be a very useful template as you think about other new products, other areas that students can do research in. So that's payment methods. One of the issues, actually, I deal with it here, is this question of the day. Because students are averse to using credit, we're finding more and more that they're not building credit. And so I think that's an important element to also teach students, given their aversion to debt. They may not be building credit, and the importance of not having a credit score goes far beyond their ability just to get loans. And so you'll see, for example, the question of the day that we list here: do checks and debit cards help you build credit? Because there is this myth out there that some people believe that they can build credit even without having through their checks or debit cards. So the next issue we're going to tackle is credit scores. And so I think the big trend here is, because students are using cash more often, there's a huge number of what we call credit invisibles, or those that just don't have a credit score. If you're 18 or 19 years old, about 80% don't. The number declines over time, but still, even at 20 to 24, almost 40% don't have a credit score. And again, I think the belief often is, well, I don't need a credit score if I don't want to get a credit card. However, as many of you know, credit scores permeate far beyond the financial services world into things like, if you want to rent an apartment, it can be difficult without a credit score. Your insurance premiums, car insurance premiums might be higher. Your employer, your potential future employer, may ask to see a credit score, and not seeing one may cause some hesitation on their front. And the credit score has permeated many more aspects of our lives, I think, than it previously had. And so the good news is, when you see a number like this in terms of the percentage of people without credit scores, is that there's a business now to try and find alternative ways to score. And so you're seeing some companies scraping websites or scraping social media and trying to look at patterns there without, it's this era of big data. There's a lot of data out there about each of us individually on the internet, and which parts of it might be relevant towards helping measure financial responsibility. And so the way we've thought about engaging students with this is through a web quest, where they would go out and identify. This specific web quest appeared on our website, and you see that NGPF has curriculum in a variety of places, and so we have projects, we have activities, we have full lessons, and then we have the blog, which is kind of a catch-all for primarily current events. And so in this case, this was an article that just recently ran in the New York Times, and I took an excerpt from it. In this case, it's talking about what FICO and TransUnion are doing in terms of setting up alternative credit scores. And then I provide some links to articles from USA Today, US News and World Report, as well as Forbes, as starting points. So students could go out and do research and say, okay, if I'm not going to get a credit card, well, what other ways might these credit rating agencies, what other elements of data might they be pulling from me, or pulling about me on the internet, in order to rate my financial responsibility. And I think that's going to be one of those aha moments, or oh no moments, for a lot of young people, when they discover that the whole internet is wide open in terms of data data gathering from these financial institutions. Two other ways that we engage students with credit scores is one, we have a case study where the students act as credit counselors, and they're given 2 student files and asked to make recommendations based on what they know about credit scores. And one of the examples, one of the 2 student files is a student that doesn't have a credit file. And so there's some work the students have to do in order to discover that, well, there actually are alternative means for students to get credit scores even without borrowing. For example, some landlords are tied into with the credit reporting agencies. You have to ask your landlord if they currently provide information, but there are alternative methods that students might want to be aware of. So even if they don't have a credit card, how they might start to build credit. And then the last is just a workshop that we did at a local high school where we had students. There's something called a FICO score simulator, and if you're given information in this case in the workshop about 2 students, you're given facts about them, you plug them into the score simulator, you discover what their credit scores are, and then you take that information and find out how much they would pay if they wanted to take a car loan out on a Mini Cooper. And so this helps demonstrate to them the fact that having a low credit score also means you're probably going to pay tens of thousands, if not hundreds of thousands, when you factor in things like mortgages, because you're going to pay a higher interest rate. And that seemed to that workshop was particularly well received by those high school students. So that's credit scores. This is probably shifting gears to budgeting and spending. This is probably the most popular chart that we have on our blog. Is teens are fascinated by how other teens spend their money. And so this is a report done by an investment bank called Piper Jaffray, and it looked at teen spending. I think the average age in the survey was 16, and shows kind of 40% of the spending equally divided, almost 20% in each was between clothing and food. And the reason I show this is it might be an interesting activity in class to have students track their spending for a month and then create a survey monkey, have them complete, 100% bar on where their spending went. And you can do some comparisons with your class, or if you teach several sections, maybe between your classes, but just getting them to think about how they spend their money and doing it in a way that it engages them. So budgeting apps are really, I did some research the last couple of days on what the most popular budgeting apps are. And based on the number of articles out there about this topic, there clearly are a ton of them available. And I saw this in The Economist over the weekend, which really described, I think, why people are so interested in being able to capture information about consumer spending habits. And in particular, banks are really being threatened here. So here's the quote I'll read quickly. Having seen consumers desert their branches, banks now worry that customers will desert their apps and websites too. Bosses glimpse a future where customers use banks merely as a utility, depositing their money there, but using unregulated startups to manage it. Smoother data sharing would make that a reality. It is a prospect that should indeed frighten bankers as much as it delights their customers. And so again, the banks are kind of being disintermediated. People are getting in between the banks and the customers and getting some very, very valuable information. So how do we teach students budgeting? I think, again, if you can engage them with apps, I think you're going to have more success at getting them to engage in this topic. In fact, I did a workshop in San Francisco, about 4 months ago, and a student came up to me afterwards and was so proud of the fact, whipped out his smartphone and was showing me his spending habits using a budgeting app. So I think they can be pretty engaging to students. So you'll see here we have a very similar project in terms of the structure of it for budgeting apps that we looked at earlier for the broader online tools and apps that we were looking at. And so in this case, the students read an article about popular budgeting apps, and then they're asked to choose one from this list provided, and then go through and really do a thorough analysis, thorough review of it. And it's even better if the students agree to to actually download the app and use it. All the apps I'm listing here are free. Students obviously have to be comfortable with the fact that many of these will link to a bank account, a credit card account. They'll link to other, so that's a risk that they have to be willing to take themselves. I think there may be some that are more receipt driven, and so you actually don't share. But as they go and analyze and compare and contrast the various apps, that's something that'll become apparent, and it'll be a good opportunity for a conversation. I think the young folks tend to be more trusting about this than folks in my older generation. But I think this is a great way to get them to, we all know that budgeting's hard. We all know that most people don't budget. However, when you look at mint.com, which is automatically collecting your information and grouping it, doing all the hard work, I think that's what often keeps people from getting excited about budgeting, is the days of kind of using old spreadsheets or having to categorize expenses. And now these apps are trying to make it as frictionless as possible and as easy as possible. And so it will be interesting to see to what extent they, lead people to have better budgeting habits. One example, actually, it's a topic I covered earlier, which kind of shows the more attention people pay to an item, the more opportunity there is for them to improve it. Is one of the companies I mentioned earlier under fintech companies is a company called Credit Karma, and they've made credit scores free. So you provide them, you have to provide them some sensitive information in order for them to get access to your results, but they provide that to you free. And then I believe on a monthly basis, you can go to their website at any point and check, but I think they also ping you with an email letting you know if your credit score has changed at all. And I think the belief is, which is probably right when it comes to behavioral finance, is that the more, like I noticed one month my score dropped, I think it was 15 or 20 points. And so you obviously want to answer the question, why? I didn't pay any bills late and there was no change in my financial situation. And what I discovered was that when you look at utilization, so again, utilization is the amount of credit you've utilized divided by the credit capacity or the total amount of credit you have available to you, that is measured at different points during the month. So for example, if I had a credit card with a maximum line of 5,000 and I paid that credit card off every month, but there were points in the month where I might have $4,000 outstanding on it, well, that's a real negative because it's looking at utilization of 80%. Even though I pay that bill off religiously in full every month, they're just measuring utilization at a point in time. So that getting that information on a frequent basis, my credit score definitely changed my habit. So now I'll actually pay off I'll pay my credit card twice a month. So I'll pay kind of on the due date, but then I'll also pay in the middle of the month in order so that when they're tracking that utilization rate, it'll be lower. So just an example of how, as this information becomes more ubiquitous, there is the potential that our financial habits might improve. So other areas where you're seeing a lot of app development is, you'll see the second bullet point there. How do you want to make savings automatic? There's an app for that. You're seeing examples. Again, savings can be very difficult, and these companies are trying to make it easier or automatic for you to do. And so two that came to mind, one actually analyzes your bank statements, discovers how much spare cash, based on looking at bank statements over a period of time. I don't know whether it's 12 or 18 months, but they look at it over time, create an algorithm, and then knowing your previous spending habits, they set aside savings automatically for you. Now, I tend to be skeptical, so I always question, knowing that for many people, their financial situation is not nearly as stable or as predictable as that. And I think there was a study that came out recently from JP Morgan Chase that showed exactly that. There's quite a bit of variability on the income as well as on the expense side for folks. And so I would question kind of how good their algorithm was at being able to predict that. The other app that I'm aware of will round up any purchase that you make, will round up to the nearest dollar and then take whatever the change is and deposit in the savings account. So the hope is if you have lots of transactions, that change will accumulate over time without you even knowing about it. So those are just two examples. I love bringing budgeting to life for students rather than making it a concept that's not specific enough. And so with the holidays coming around, it might be an interesting time to have students create a budget if they plan on giving gifts during the holiday season, to create a budget for that and then analyze how well they do in keeping to that budget. I've also seen other teachers use the prom as an opportunity for that also. Credit cards, which obviously, segueing from budgeting to credit cards, these are the financial instruments that probably make it as hard as any other to keep a budget. But this is a new look credit card that many of you may be seeing showing up in your mail these days. And this is a chip credit card. As you know, there have been massive frauds at retailers such as Target and Home Depot. And this is an attempt where actually the U.S. is one of the last bastions that used the magnetic stripe. As Europe, I believe Europe and Asia both went to the chip quite a few years ago. So I think this is an interesting opportunity to have students do some work around, what's going on with credit cards. And the date of switchover was October 1st. And what changes on that date is really the liability for fraud. So if after October 1st, a retailer, what they're trying to do is give retailers an incentive to upgrade their credit card machines. And so if there is a fraud that occurs after October 1st, somebody passing a fraudulent or using a fraudulent credit card after that date, then the retailer is on the hook, or could be on the hook for that fraud. And so they're trying to give the incentive. And the issue is, especially with some smaller merchants, is it can be quite costly for them to upgrade their machines. But what this chip does is creates a unique number. So for every transaction that you use it for, it creates a unique number, which apparently makes it harder for folks to hack. Although if you do a quick Google search, you will discover that hackers are always one step ahead, and somebody's already figured out this card also. And so that leads to, so the first is the web quest. And the good news is, when there is an event like this taking place, there's a lot of news articles written. And so this gives students an opportunity to read critically, to read from multiple sources, to understand perhaps what's driving some of those sources, what motivation they have to either portray chip cards as being safe or chip cards as being less safe. But that's really the purpose of that web quest. The question of the day, which is generally structured as a question to really kick off class, would be, are these chip-enabled cards safe? Are they safer? Are they going to prevent fraud? I know with my card, for example, which came in the mail probably 2 weeks ago, I have yet to use the chip yet. So the retailers I've been going to just continue to swipe the magnetic stripe. And if you hear listening to what Visa is saying, they understand that this is going to take multiple years to implement over time. So my guess is they're going to go easy on the retailers in terms of shifting the liability to them and give them time, because I've yet to actually use my chip yet. There is some innovation occurring in credit cards, and so discovered that one major credit card company actually recently introduced a new feature called the kill switch. And I think the purpose of the kill switch is it enables you to, if you believe any fraud has occurred, you actually have the ability as the card holder to shut down your card immediately. So it doesn't require a call into the credit card company, but instead you can just go online and kill it immediately to stop anybody from continuing to use it. So that's kind of an interesting new feature. I think one of the things that's driving that is the increased cost of these chip cards. So they prefer not to have to constantly send you new cards. And that leads to the next topic. And I think this is particularly well geared, this issue of identity theft. You really can't teach, what was being taught 2 or 3 years ago about identity theft probably needs to be updated today, because there's always new schemes being established. And so what this shows is a pretty frightening chart, actually. comes from the Bureau of Justice, compares numbers from 2012 and 2014, and shows basically continuing the rates of identity theft. So what this says is almost 7% of people in 2014 had at least one incident of identity theft. And the two largest sources of that theft were your credit card accounts and your bank accounts. So pretty sobering. And there's another stat which I couldn't pull in time for the call, and that is for students who say, well, I don't have a credit card account, I'm under the age of 18, I don't need to worry about this. It turns out that those minors are actually much more likely to have an incident of identity theft because the thieves know they're not checking their credit actively because they don't have active credit accounts, and they'll go ahead and set up accounts in their name, and then they'll discover when they do take a first glance at their credit report that there are instances of somebody else using their identity to set up bank accounts or set up credit card accounts is probably the more likely thing. But so these are the two most frequently cited. So in terms of whether people believe or not believe whether they're going to or be immune from identity theft, this chart ought to set them straight and showing them how prevalent it really is. And so try and come up with ways to teach this concept. And so one day I did a Google search, and again, it doesn't take long to find a lot of examples of identity theft. And whether it's, in this case, I compiled a video montage, and I apologize to Paul Simon. My corny title for this post was 50 Ways to Swipe Your Credit Card or Debit Card Numbers. And it just looks at stories that ran within a 1 week period, I think. 2 to 3 minute videos being reported by various local news stations about ways that people are stealing credit card numbers or debit card numbers. And so the purpose of this is really to have the students watch these videos. I think if you total them all up, it's about 15 minutes of video. Have them jot down what the scheme was. They're each a little bit different in terms of how they stole their numbers. And then think about how they could protect themselves from becoming a victim, because ultimately that's the most important thing that we want to be able to teach them is what are safe habits that they can have in place to prevent it from happening to them. We also have an activity baked into our curriculum called Build a Scam Guidebook, which is exactly as it sounds. The students go out and do some research on I believe it's 3 to 4 different scams, and provide detail in understanding how the scam works, and again, how to protect themselves. And then the last idea is just a WebQuest activity, because there's no shortage of articles about providing advice for people about how they can protect their identity. And so that's the final idea at the bottom of that slide. Okay, I want to take a moment here, take a break, and just ask another polling question. So I'm going to send this one out. And here I want to know really what sources of information do you turn to in order to stay current on personal finance topics? Because there are, one of the problems is it's drinking, as the picture I sent out with this webinar, it sometimes feels like drinking from a fire hose. And so wanting to learn a little bit more about where you turn to for this sort of information. So I'll give you about another 30 seconds to answer that. All right, so here's what we saw. It looks like we have some avid news readers here. That was the number one source. I think when I talk to personal finance teachers, they seem very attuned to reading the events of the day. Curriculum providers are second. Conferences, webinars, PD sessions third. And then further down the list, Twitter, social media, and personal network. All right, thank you for your responses there. So now we're going to shift to investing, subject near and dear to my heart. For those of you who might have missed it, we did an earlier webinar about um, various activities and projects you can use in teaching investing. And I think I'm going to focus on three trends here, three trends that are the most relevant. One is this rise and increase in what are called target date funds. So dedicated to retirement, investing for retirement, which we just released a few weeks back. And for me, this is an incredibly important topic to teach students. Yes, they may be, if they're in high school, they may still be 4 years away from graduating college, or 5 years or 6 and stepping into their first job. But the sooner we can teach them about the importance of investing for retirement through their 401k plan, the better. And what's happened here is, 401k plans, I think on average have about 20 to 25 funds listed. And so talk about an intimidating thing for a recent college graduate to look at on their first week at work is this list of 20 funds with weird names and nomenclature and acronyms that they're probably not all that familiar with. And then along comes something called a target date fund. And what target date funds allow you to do as a young person, or actually anybody, is you buy a fund, basically, you buy one fund, and it has a target date, and the target date is your retirement. So let's say that I was planning on retiring in 15 years. I would look at a target date fund 2030, 15 years into the future. And then the beauty of these funds is that they automatically adjust the asset allocation as you get closer to retirement. And so they're required to disclose this in their prospectus, how they do it. In very simple terms, it's a stock-heavy portfolio when you're young and gradually shifts more towards bonds as you age. And again, in their prospectus, they actually show you how that shifts. And many of them use index funds as their investment. So they have a low fee structure also. But you see, and I was surprised by this because I hadn't realized this trend was taking place, but you see this chart here shows that folks in their 20s, 52%, over half, have a target date fund in their portfolio. So clearly they like the simplicity of it, and it's kind of, you buy it once and they're doing the asset allocation over time, they're doing the rebalancing, and it can be a good core holding. I don't know if that's 100% of what you want for your retirement, but it gives you a diversified portfolio at a low cost, and there's a lot to be said for that, and clearly that's why those are so popular. So that's target date funds. The second big change, and this has happened more over time, is just this move towards index funds. People are waking up to the fact that it's really difficult to beat the market, whether you're somebody who likes to buy individual stocks or you want to hire a mutual fund manager who's paid to beat the market, because it's been an exercise in futility. If you look at any research, any rigorous research reports, you'll find that over time, a very small handful of folks are consistently able to beat the market as a result of skill versus luck. And clearly, the Warren Buffetts of the world receive a lot of acclaim and a lot of notice and a lot of newsprint. But as he would be the first one to admit, for 99% of the population, we actually have a video of him talking to LeBron James about investing, where he gives that advice to LeBron and also says it applies to 99% of the population, which is to buy an index fund. And then this chart does a good job of just showing the yin and yang, the ebb and flow between, actively managed funds. So again, actively managed means you invest in a mutual fund that has a manager who's trying to beat the index, versus an index fund where, I should have given an explanation earlier. An index fund is basically a fund that buys stocks that form a given index, and there's a plethora of indexes out there, the most popular being the S&P 500, which is made up of the 500 largest companies in the US, and that's weighted by market cap. So in other words, if you own the S&P 500, you own a lot more of Apple stock, which I believe is the highest market capitalization, the largest company, versus a company that's number 500 on the list. And so those are market cap weighted. But there are indexes that are equal weighted, where they buy each one of the S&P 500. They buy 2% of each of the companies. for example. And so there's every flavor, because as you can imagine, these financial service firms know there's a trend towards indexes. And so they're willing to kind of meet the demand of consumers by rolling out more and more of these indexes. But you see clearly a shift away since 2007, money coming out of active management and going into index funds and ETFs also, which I haven't explained. ETF stands for Exchange Traded Fund. And the way to think about them is they're just a security, very similar, usually made up, consisting of a similar set of stocks as an index fund, but the difference is they trade on a stock exchange during the day. So normally when you buy a mutual fund, you put in a buy order during the day and they would give you the price that the mutual fund was worth, whatever the net asset value was at the end of the day. With an ETF, you're getting a price. It's traded similarly to a stock in that it's traded on a stock exchange over the course of the day. So if you want to be assured of the price you're going to get, you can trade it actively on the markets. And so ETFs tend to be better instruments for people who are active traders. So that's the second big trend, is just this movement toward index funds. And I bring this up because I know most high school teachers are enamored, many of them are enamored of the stock market game. And so I would just encourage you, when playing that game, to ensure that students have opportunities, or to make them aware of the fact that index funds are also available for them to purchase. And so, for example, when I played the game, I always make it a point to compare the results of the students versus how the index, and the S&P 500 is the one I tend to use to show. And usually some students beat it, some students fall short of it. But over the problem with the stock market game is it's a much shorter term game. And so you can have periods of time where more of the class outperforms the market, which can happen over short periods of time, but is much less likely to happen over long term. But I would just encourage folks to be sure they include index funds in their discussion. So the last phenomenon is this thing called Robo Advisors, these companies. And so we all know that Google popularized use of the algorithm in terms of identifying the best results for our searches. And so now what's happened is algorithms have moved to the investing world. And so this was a question that Charles Schwab asked earlier this year, and they asked folks to make a choice. If you could choose between an investment portfolio based on a sophisticated computer algorithm and an investment portfolio developed by an experienced financial advisor, which would you choose? And so you see, again, even robo advisors have not been around that long, but you see among millennials, it's 60-40 today. And my guess is that number is going to continue to increase on the computer algorithm side. And why is that? I think it comes down to largely cost again. A financial advisor may charge upwards of 1% to manage your money, and many of these robo advisors are at 0.25%, and they're buying index funds they're setting up an asset allocation for you based on your age, based on your profile. I think many of them use the same sorts of inputs or the types of questions that they ask, and then they model a portfolio for you. And they build in things like automatic balancing, so you don't have to worry about that. Rebalancing, occurs, maybe at the end of the year if one part of your portfolio, like emerging markets, has grown significantly, and so now is 20% of your portfolio instead of 15. You might rebalance by selling the emerging markets and buying the others to get it back to a model portfolio. They take care of that. They do some tax loss selling. So if you have losses in your portfolio, they'll take tax losses and then buy similar type securities. So they're providing services that I think what's so remarkable about them and why they're catching on is they're providing a lot of services that previously were only available to high net worth individuals, and now they're bringing it down to mainstream America at low cost. And I think that's kind of the major innovation here. So we'll be interested to see how that goes. So those are the three major investing trends that I see. And in terms of how do we teach, what are some ideas on how to teach students or force students to make decisions about those? One is we have a project, and this is a pretty amorphous unstructured project where we have students build a portfolio. They act as a financial advisor and build a portfolio for themselves. And so here's kind of the scenario that we've created. We give them articles and videos to watch and read to provide them. So presumably this project is occurring at the end of the unit, but we're giving them information you can see about passive index investing. Students love this LeBron James and Warren Buffett video also, and then diversification and some ideas about portfolio allocation models. And then they go in and build a portfolio. The guidelines we give them is they can choose any combination of stocks, bonds, index funds, mutual funds, or even investment ideas. And then I think the more important part is the presentation. So they have a choice here of either writing a report or presenting to the classroom. So it gives them an opportunity to hone their communication skills too. And so that's an example of our project. And I haven't talked a lot about, our curriculum. We have, I think, 40 or 50 projects like this in our project bank. We also have an activity bank, and these are all available directly from our website. Question of the day that we utilize is, would you let a robot invest your money? This gives students an opportunity to do a little bit of research on Robo Advisors. What are some of the pros and cons? I think the reason I think this phenomenon is going to take off is you look at, first of all, I walk by this company every day on my way to work, but no, that doesn't have anything to do with it. I think the reason, when you look at the incumbents, folks like Fidelity, Schwab, and Vanguard, three of the bigger mutual fund houses, when you see them developing comparable services to robo-advising, then it's more than just a couple of startups with this crazy idea that probably won't catch on. And so I think that's here to stay. And so students have to learn how the robo-advisors differ, so they have a good understanding. But I think they're going to be much more comfortable making choices. Using technology, in effect, it's technology enhanced investing. And rather than dealing with an individual, they're going to be much more comfortable with using these algorithms. The last example I have here is just this game. It's this neat little tool that I found called Can You Time the Market? It gives students an opportunity to buy and sell over the course of a simulated 10-year period. And I think you'll find that it's an engaging game, and you'll often find that students don't do a very good job of timing the market. So we're trying to teach them that buy and hold is probably a better strategy, because the ability of any pundit or expert to predict the directions of the market, even one day ahead of time, is not very good. And so much better to be in the market, which has had an upward bias historically, than to try and get in and out and time it. Last category, and I know I'm bumping up against time here, so I'm going to move quickly, is paying for college. And the focus here, rather than trends, is I think there's been an explosion of information that's now available to students and their families when it comes to paying for college. And so the example I've given here is some output from a recent website put out by the government, the Department of Education, called the College Scorecard. And what it tracks, it really takes a lot of the information from an old site called College Navigator, which, despite its name, was not exactly the easiest to navigate, and kind of brings it to the 21st century and makes the data much more accessible. But they also added, so for example, the output here, looking at these colleges, you have average annual cost, you have graduation rate, and I would argue, you can dig deeper into these numbers, so you can actually get average cost or net price by income level, graduation rate, and then the third is salary after attending. So what they've done here is they've linked up with compensation data, I believe from the IRS, and they're looking here at what are the graduates of this institution, graduates who have received federal financial aid, what are they earning 10 years after they left the institution? Or I believe it's 10 years after they left the institution. So now you're getting outcome related information. So, and obviously that data, and we've got a ton of charts on our blog about this, that data varies dramatically by college major. And so you can still peel back the onion a little bit further on that. But this is a really easy to use website, and it's got a ton of data and hopefully helps people make more informed decisions when it comes to college. And then there was this tool that was put out by the New York Times, and again, this is on our blog, where you punch in the name of a school or you type in the name of a college, and it provides you net price by income level. So I apologize that this isn't the clearest, but the college I used, which right down the block from our offices, is Stanford University. And you'll see if your income is between $0 and $30,000, your net price is $4,000 versus a sticker price of $58,000. And so it's a nice graphical chart that shows as income level rises, net price rises also. And so for those of you who are math inclined, it would be interesting maybe to look at 3 or 4 different colleges and graph them all on the same graph and see kind of how these curves change, public versus private, perhaps being or elite versus non-elite, how these numbers might vary in the steepness of the curves versus the flatness. But that's just a real easy graphical display of, and this is something I'll use in my summer course when I teach at a high school in a lower income community, and this is something they're very sensitive to understanding, that for many colleges, for most colleges, the less your family earns, the more financial aid that's available to you, and I think that's an important message. So in summary, what I've tried to do here is present you with both trends, 2 or 3 trends for each topic that I think is important for your students to understand, but more importantly, various creative ways that you can use so that students, this is more student-centered learning where they're going out and doing the research, because ultimately I think that's how I know I'm doing my job well in the classroom. Is 10 years from now, am I hearing from students about decisions that they're making and the thought process they went through to arrive at those decisions. And so using techniques like web quests, new product research, put them in the seat of being a product reviewer and giving them a list of questions and forcing them to communicate those either in writing or through a presentation, using questions of the day to engage them about current events. And then lastly, data analysis. I showed you my belief in putting this presentation together is that a picture is often worth 1,000 words. I think it's something like that anyway. But rather than put a lot of words on a page, actually providing you with charts and graphs that really displayed what's changing in the world of personal finance can be a great way to engage students too, to not tell them what the answer is, but throw some of these charts up on the board and ask them to respond to them. And I think the important link is always asking, so how is this going to impact you? How is this going to impact your financial health? So that is, I know we're bumping up against the time now. I'm going to take a minute here and just look at questions that have come through. I would ask, if you are jumping off the line, it would be great to have you answer the survey. In particular, any ideas you have for future webinars, that would be helpful. Thanks. All right, I see that we do not have any questions or comments. So in closing, I just want to thank you again for taking time out of your busy. I know all of you have had a long day at school today, and I appreciate you taking the time to learn more about trends in personal finance. And then I would just point you towards these useful links where you can access any of our information. Any of the information that I provided today will be available when we send out the handouts tomorrow. And thank you again for joining us today. Take care.